Welcome to the Business SOS podcast. This is Rich Sierra, president of the Florida Small Business Legal Center. This is episode 125 of the Business SOS podcast. Thank you for listening. I truly appreciate the support you've given me for the last 2.5 years. Before we start, I certainly want to wish everyone a happy Hanukkah and also Merry Christmas and happy holidays, since this is a pre-holiday edition of the podcast. So today I'm going to switch a little bit the topic. For the last few weeks, I've been talking primarily about litigation topics. And so today, I'm going to talk about what sellers don't tell you when you buy a business. Lately, I'm getting calls and emails about people wanting to buy or sell their businesses. Maybe it's the end of the year. They want to kind of wrap things up and have a different chapter after they sell their businesses. So I want to talk a little bit about that. And I've done podcasts about this subject before. So this is kind of a revisiting of the same topic, but from a different twist. And I believe it was over a year ago. I think it's episode 53 of the podcast. You want to go back, check it out, you're welcome to. So I think I went to a deep dive into the due diligence checklist in that episode. But today I'm going to talk a little bit about that, but I also want to talk about things that people overlook, or perhaps what sellers sometimes don't tell you when you are buying a business. And there's a two-way street here. The sellers have an obligation to disclose material information that could affect the performance of the business if you're about to sell it. And I'll just give you an example. If the business relies, say, on 5, and maybe it has 50 clients, but 5 of them generate 80% of the revenue. Just give you that as an example. And the seller does not know, or has a good feeling that perhaps 2 of those major clients may not renew the contract for whatever service. Okay, that's not something that's going to show up in any financial documents. That's not something that is going to be showing up anywhere unless the seller requests that, voluntarily provides that information, or if the buyer asks that information. Okay, but if the seller knows that, hey, this contract that represents, say 10% of my entire revenue for the year is not going to renew, that's a significant drop in revenue. And sometimes that information is not provided to the buyer. So it is important to understand that and to know, number one, what due diligence questions you need to ask if you're buying a business. And number 2, making sure that you ask the questions that are not reflected on the financial documents. And I get, people buying businesses, and I say, what information have you reviewed so far with respect to the financial status of this company, financial condition of this company? We got the tax returns, and I got some P&Ls. That's it. Okay, there's a lot more information that tax returns and P&Ls that gives you a story, the history of that business. So I'm not going to go today to a due diligence checklist. Maybe perhaps I'll do an episode of that in the next coming weeks after the first. But for today, I want to talk about some of the issues that perhaps you should be aware of that sellers sometimes do not disclose voluntarily. If it's not asked, they're not going to disclose it. Remember that when they're selling the business, they're going to present the business in the best possible light for you to buy it. And there's brokers involved. Sometimes brokers also help in that situation, that they want to sell that business. They're going to get a commission. So when you have a business broker working for the seller, please understand the business broker is not working for you as the buyer. Yes, they'll provide information to you. They'll be friendly to you, but they're not there to represent both sides. They represent the seller, and there's a vested financial interest in the business broker on closing that deal. Granted, if the business broker knows some information that can affect that business negatively, the broker has an obligation to disclose it. But if you don't ask that information, then you're on your own. So let's go specifics here. Revenue that looks very strong on paper, but it's just not sustainable. And I'll give you an example of that. Is that they say we generate $100,000 a month in business. For the sake of argument, say it is a online company selling goods online or Amazon, but something you begin to say, what is your cost of goods sold? How much you pay your employees? If you have a lease for a warehouse, how much is that? And you begin to see that something is off with the revenue in relation to the net profit, or that it is seasonal. So when the revenue looks too good, you just got to find out, getting more information about that. Sometimes the financials do not reflect the true picture. They might remove some expenses, which frankly, they should not do that, because that is fraud. When you begin to take out information from your financials in order to present a better position, that is just fraud. Okay. So one of the things that I recommend to prospective buyers, my clients that are looking to buy in a business, when they are given financials, find out who prepared those financials, whether it's an accounting firm, a CPA firm, or something that is prepared by the seller. Okay, I think that I like to rely more on financials that are prepared by a CPA firm or an accounting firm, and have a little bit more information how those books and records are kept. Is that something that the seller himself enters information into QuickBooks and basically gives the accounting firm and accountant access to it, and those entries are not looked upon, and they just basically are taken as face value and transferred into the P&L. So you got to find out more about that. And depending on the type of business you're buying and the amount of money you're going to spend on buying this business, then you got to find out whether you want to get unaudited financials to have more reliability upon them. Okay, but going back to some of the things I've said before, I recommend that if you're going to buy a business, you certainly should have an attorney helping you who has done this before, and also an accountant as well. Not an accountant that just focuses on taxes, but an accountant that understands what you're looking for in evaluating a business. So just have those two professionals on your team, so that way you'll be better equipped to make a better informed decision on whether or not to go forward. Sometimes cash transactions are not fully reported. You got to find out how much, if this is a business that takes cash, what happens to that cash, if it's reported or is it accounted for. So you got to ask those questions. The customer concentration, when you look at sales, and that's, again, not reflected on your tax returns or the financials, okay? How many customers does that represent, depending on the type of service or business that you are in, okay? Is it, say 100 customers, and is everything even? Or if it's something, a certain number of customers generate most of the revenue for the client. And I just give you an example for the seller. An example I could give you is, say, if you have a pool cleaning company, okay, and I've dealt with some of these types of transactions in the past, and pool cleaning company, especially in South Florida, has so many pools, and so you have a company that goes every week and cleans the pool and provides maintenance for that. Whether it's residential or commercial, you got to find out first. Another question that you might want to ask in this case is, okay, how many of those commercial accounts are they on long-term contracts, short-term contracts? The same thing with residential accounts. Are these accounts on a month-to-month contract or a long-term, maybe annual contract that renews every year? What is the history or the length of time of these accounts? The stability of the accounts are very important. Are they new accounts, or the accounts the accounts that just came up because they're trying to sell the business? How many accounts drop from year to year? It's important. Look at a 3-year history of those accounts. If you're going to buy that business, you want to make sure that revenue continues to come in. So where those clients are coming from, what is the concentration of clients in reference to their revenue is important. And there's a way, I know sometimes when sellers are looking to sell the business, they do not like to disclose their client list for obvious reasons. There's a way that it can be done by blinding that information and putting a different code to those customers, having a third party review it. There are ways to get around that. But the important thing is that you want to make sure that you have the information that you need to properly evaluate the business. And I've had situations that people buy businesses and I just people buy businesses, but then when they request updated information up to the time of closing, the seller says, no, I'm not going to give it to you. And then they still buy the business. So if you have a situation where the seller does not want to disclose information to you, that is a huge red flag. And you got to have a pause to that and say, why not? And then you can have a discussion about that. But if the seller does not want to provide information to you, that you request that you're entitled to that as part of due diligence, you go ahead and buy that business anyway, then it's on you because you ratified that. You cannot go back and say, well, I bought this business and the seller did not want to give me information, but I still bought it. Then it's on you. Okay? That's why you need a team of professionals helping you giving you the advice to make these types of decisions. Unpaid payroll taxes, sales taxes, or accounting irregularities. If the company has payroll, the employees, and I've spoken about this before, it is essential that you make sure that they are current with their payroll taxes, also with their state taxes, okay? And there's a different type of tax return for that. It's not the federal tax returns that you see that we are familiar with, the 1120S, okay? I believe the IRS, the payroll tax return for the IRS is 941s, and the one for the state is R6 in the case of the state of Florida. The reason I say that is because sometimes you might end up inheriting those problems if you do not request that information. So ensuring that the company that you're buying, they're current with their payroll taxes, their sales taxes, is very important, and your accountant will help you assess that information. And also finding out whether those employees, how many of those employees are true W-2 employees that they're paying through a payroll, or the business is utilizing employees but paying them as independent contractors. That is another issue, okay? Because then you might have, if you inherit those employees, you might have an issue of unpaid wages. So understanding the breakdown of employee classification, it is very important. And sometimes the seller does not disclose that. Small businesses usually have key employees. You have the owner, you might have the spouse, you might have 2 or 3 key employees there. You have maybe 1 key employee that really knows that business inside and out. So a question that, again, you need to ask is, what's going to happen with this employee if I buy the business? Now, you cannot force anybody to stay. They can leave, okay? However, if you buy this business and that the history of the business, that knowledge that this key employee has goes away, the value of the business is going to go down because you have to learn things from scratch. It's going to be a learning curve. So understanding whether this employee is going to stay or not, or you can work out some type of agreement for the employee to stay through another contract, that's something that has to be discussed beforehand. A business that operates primarily from the seller involvement is also something to be aware of. There are businesses that can run because they have a staff of people already, a team already has been trained, and they know what they're doing. But if the business depends primarily, let me rephrase, if the success of the business depends primarily on the owner's involvement, then you might have an issue there as well, and you need to make that determination. How is this business going to run without the owner being there. I mean, it's the owner has the relationship with the key accounts, how that transition can take place, where some employees, some customers will leave because the owner is not there. So understanding that dynamic is very important. I will look at also if the business requires has some equipment, find out where they have leases on that equipment and also the condition of that equipment. People just sometimes are going to buy this type of equipment, and like, for example, restaurants, and then they don't look at the condition of the refrigerator. They don't get a mechanic there to inspect the equipment. Then you will have an issue. Again, there's certain things that do not show up on a tax return. There's some more intangibles, but they're important because you don't want to go into a business inheriting problems. You want to go into the business to recover your investment and make a profit and start running that business effectively once you sell it. One of the questions in due diligence that we ask, this will be, in terms of topics, I'll give you what the topics that I'm looking at. This is number 3, is legal landmines buyers discovered too late. All right. So, one of the questions that we ask is whether or not you have had any type of litigation the business has had in the last 5 years. That is easy to find out through public records. And we use software. We have availability to see lawsuits nationwide. So any lawsuit that has been filed, we can find it through an online system, so it's easy to find. Okay? And they have to disclose it anyway. What you will not find in a public records is whether or not the business that you're considering buying has been through an arbitration, or it has been through mediation, a pre-suit mediation, or they have received a letter threatening litigation, or they have sent a letter threatening litigation. None of that is in the public record. In the case of arbitration, the only thing you will see is an award if this get recorded with the local court. Then you'll see that in the public records. So you need to ask the seller to disclose not only the litigation they've had in the last 5 years, but also whether anybody has threatened with litigation in the last 5 years, whether it's an email, a letter, or an attorney letter. That will not show up in the public records. They got to tell you that information. You also got to find out whether they have been a party to any arbitration proceeding, because that will not show up. And I think I touched upon arbitration a few episodes back. In arbitration it's a private court. And one of the most popular ones you've heard is American Arbitration Association. The process is similar to going to court. And I'm just using a general example, but in essence, you're hiring a private judge in a private court, quote unquote, which is to administer the process. So in this case, the American Arbitration Association is hired to administer the case. You pay them a fee, and they handle the case management process. An arbitrator is appointed who becomes the de facto judge for that particular case. And they have to be paid separately. That is a separate process. It's a private process that is not shown on the public record. So you got to find that out. Have they paid any settlements as a result of a threat of litigation? That's important to know. And why? Again, there's nothing negative if there's any type of threat of litigation that could impair you from buying the business, or you might dissuade you from buying it. There are provisions you can put in place to protect you. That's a different conversation altogether. The point is, you need to know that information so you don't have surprises at the end after you buy that business. And then once you got that information, then you can make an assessment of whether or not you want to buy it or not. After you consult with your attorney, what is my risk about this business based on this information that we have, this type of litigation, arbitration, or settlements, or threats? So just find that out. Again, it's your obligation to ask. There are seller's obligation to disclose if it's material. They might say it's not material, it's something that, we're not worried about it, but if it's something that they get a threat of litigation, they should disclose that. But it's your obligation also to ask those questions. And sometimes many people forget to ask those questions or choose not to ask them because they're excited about buying the business. Okay? So just keep that in mind. Definitely reviewing the commercial lease and very carefully. Sometimes they have assignment restrictions. Actually, most leases have assignment restrictions with respect to the landlord has to approve the assignments. That's a given. But if there are conditions for that assignment, then you have to look at that. How many years left in that lease is very important. If you have a lease that is going to expire in 1 year, you got to find out whether you can renew that lease or have a longer extended term. Because why would anybody buy a business knowing there's going to be a 1-year lease on the premises, and then with no possibility of getting extended? So the lease evaluation is completely different. As a separate category altogether, and I can do a podcast on evaluating the lease as well. And I've done some of them if you look at episodes back. But sometimes the seller does not want you to talk to the landlord unless there's some type of deposit and, there's a purchase agreement. You need to be able to speak with the landlord. You need to be able to look at that lease and evaluate whether or not the lease works for you. Intellectual property also analysis you got to do. Whether the trademark that they're utilizing is a trademark that is valid, whether or not they can actually utilize that trademark. So you don't get a trademark infringement letter at some point. And domain name, social media, you have to look at that. Obviously, look at reviews, and that's not something that will be reflected in the tax returns. And you'll be surprised how many people that I get calls say, I bought this business, I did not know they had bad reviews. That's available. Okay? The seller's not going to tell you that. You have to do some due diligence yourself to make sure that you evaluate the business properly. I want to talk for the next few minutes about the seller's attitude, the seller's demeanor or behavior with respect to the sale. Okay? One of the things that I caution my clients about is when I get calls or get emails, hey, listen, I want to buy this business. The seller told me to sign the LOI by tomorrow. He wants a $10,000 deposit. By tomorrow, the wife's going to sell it to somebody else. Okay? The concern that I have with deals that are fast, deals in which the seller creates an artificial sense of urgency that creates a sense that, if you don't take this deal now, I'm going to sell to somebody else, is that there's something else behind it, that the seller needs some cash and needs it now. And I had an example of that a few months ago, okay, which my client was going to buy a restaurant, and the seller always kept insisting on, non-refundable deposits. And it kept insisting on, if you don't sell it now, I'm not going to sell it to you. And they kept insisting on really fast type of transactions. And I told my client, you got to slow this down a little bit. Something is up here, and we need to find out more about it because it doesn't make any sense. And if you have an intuition something is not right, most likely your intuition is right. So you got to follow your instincts in this case, okay? So fast deals usually do not end well, okay? Especially when they shorten the due diligence. He only wants to give me 1 week for due diligence. I'm like, that's not enough time. We came to find out that the reason he wanted the cash so quickly is because he had a different lawsuit he needed to settle. As we begin to do our due diligence, find out that he had a pending lawsuit. He needed the cash to be able to settle that case. And so you got to find out the motivation of the seller in order to go with the transaction, why they're selling. Okay? And again, there are many different reasons why a business owner sells, But you need to be aware that once you buy that business, the seller is gone, it becomes your responsibility. Unfortunately, we did not close in that business. Something was up, okay? We tried to work it out, it just didn't happen, okay? But at the same time, some people, and it happens more frequently that I like to, that should happen, is that buyers sometimes get manipulated. They get wrapped up and they just start sending money without a proper purchase agreement and without safeguards for that deposit. They put it in the seller's business account as opposed to putting it into an escrow account with safeguards that if the transaction does not go through, that money can be returned back from that third party back to the buyer. So, I mean, it happens very often that they start these deals without attorneys. They put the money into the seller's account. Something goes wrong. They don't want to buy the business. They lose their deposit. And then they come to my office and say, hey, I want to get my deposit back. So, yeah, I can do it, but it's going to cost you as much as the deposit. So using common sense here is very important in not rushing the sales process. Do not rush due diligence. I cannot emphasize that enough. Don't rush due diligence. Just take your time. You need more time, ask for it. Clearly, everything within reason. Okay? I think for most small businesses, 30 days is adequate due diligence, provided that you're given that information when it's requested. And if it has to be extended, it has to be extended. But it's important for you to do that properly. Side deals, resistance to providing documents and complete records. That's another red flag. That when you ask for documents, they slow walk the documents, are not ready, the accountant has it, the tax returns are in extinction, sometimes extensions that do not exist. That's a red flag, okay? If the seller is going to sell that business, the seller should have already have the key documents prepared and ready to go when they're requested. Otherwise, they should not put that business up for sale in the first place. So they should have three years of tax return. They should have the bank statements ready to go, profit and loss statements, financials should have some key documents already in place. Another question that sometimes people do not release is whether or not they have loans outstanding that they owe that have a lien on the company. Sometimes they don't share that. And there's a easy way to find that out, which is through Florida UCC. Most people don't know that. If the loan is recorded, you can find that out whether they have a lien, there's a lien on the company. But sometimes sellers don't share that. They just want to close. Oh yeah, I'm going to go ahead and pay the loan with the money that I receive. No. If there's an outstanding loan that the company pledged its assets, the money has to be placed in escrow from the closing, and then the closing agent will pay that loan. That's the proper way of doing it. What I see here happening as well is that sometimes sellers and buyers do side deals that are not reflected on the purchase agreement or to an addendum. Happens very often. They become friendly, so don't worry, I'll take care of that. You don't have to worry about it. I'll show up every day. The contract says I have to show up once a week. Person doesn't show up. Then they call me and say, well, he didn't show up every day. I said, well, what is in the contract? Well, once a week. But he told me, it's like, it doesn't matter what he told you. It's what's in the contract. You get kind of my gist of what I'm talking about. You know, it's important for you to do due diligence, not to rush deals, ask the proper questions. And if you have to walk off from the deal, walk away from it. I know people get excited. They get somewhat enamored about the idea of owning a business. And they seem to overlook red flags that are clearly there just because they are sold the idea of running a business. They're given assurances by someone, whether it might be the business broker, whether it might be the seller himself or herself, and then they go ahead and buy it, and then they find out that the information that was provided to them, it is not true, and they inherited a problem, but the money's gone. So having that information is very key. And there are a lot of different techniques and tools that we can use with respect to protecting the buyer's interest. And that's for an attorney to help you with that, and also a CPA with respect to financial analysis as well. So there are many different ways you can protect yourself. The simplest way is that way, if you're going to buy a business, is retain an attorney who has done this before that can help you navigate those waters. Buying a business is very important, and it's not something you're going to be doing every day. It's one of the most important business decisions perhaps you're going to make in your life. It's a life-changing decision. So trying to shortcut that process, trying to save money, as I've heard it many times, on buying a business does not make any sense considering the investment that you're going to make and the time and effort you're going to put into this. Because there are not too many safeguards here unless the ones you place for yourself by hiring the right professionals. And I've heard it before when sellers and buyers says, oh, we don't need lawyers for this. We can do this ourselves. That's fine. 6 months later, I do get a call from the buyer. Yeah, well, I bought this business. The seller misrepresented. He lied to me. I'm not making the money I was supposed to be making. What type of due diligence do you do? Very little. Well, let me show you the contract. The contract is homemade. And you're not talking about small amounts of money here. Sometimes I see businesses being bought $300,000 or $400,000, and they do this thing on their own. So if you have any advice from me, is that before you buy a business, consult an attorney that can help you with this, so that way you get the proper legal advice and you have a successful purchase. And of your business, you can move on and be successful as well. You have the right professionals helping you and analyzing the business and also with the purchase documents as well. This is good for today. I want to thank you again for listening. This is episode 125th of the Business SOS podcast. I want to wish everyone happy Hanukkah and a Merry Christmas, happy holidays, and hope you have a safe and happy holiday with your families. And I thank you again. This is Rich Sierra with the Florida Small Business Legal Center. And remember that my goal is to help you succeed.